You know, we need to really understand that our client, what they really want is from us to tell them what is their future value of their investment. Okay, and especially is after all those costs, risk, and tax. So here I'm going to summarize. I just have summarized a table and looking at under different account, what are the future value for every $1 investment, right? Um, every $1 investment under different scenarios, right? Different type of the account. So let's look at that. There's four possible types of account. One is the taxable account, the accrued tax. So we don't do anything, it just invest there and the investor need to pay tax every year. Another one is a deferred capital gain tax account. It's more like the pension saving account, not saving account, a pension account like a 401k or IRA. Another one is a tax deferred account. It's truly based on the income tax part. All right, we try to set up account they're able to defer their income tax. All right. Another one is the tax exempt account, which means they don't have to pay tax. So let me clarify that. Right, the first two is easy to understand. The third one usually happen is that when the people retire, they don't have other wage salary income, so their major income source is from the retirement payment. So in order for them to minimize some of the tax exposure for paying the income tax, right? Just the income tax. So there's some kind of account that can be deferred to the future. It's called the income tax deferred account. Now, tax exempt account is an account there serving for special purpose. It's a tax exempt. For example, it put into a trust, a special donation, invest to some government tax exempt security like municipal bond, and so on. So it's a special design that able to away from the tax, and but there's a drawback there. Of course, you may lose your ownership. But anyhow, for some wealthy investor, for the estate tax purpose, they're willing to do it. Okay, so anyhow, there are four different type of account. Now, if you look at the future value of that account in terms of future value, if we rank that one, the lowest value is a taxable account. The highest value, of course, is tax exempt account. An interesting thing is that the number two rank in terms of the highest value is a deferred capital gain tax account. It's more like today's 401k and IRA account. So why? The reason is very simple. We calculate that. The first one without tax, we use, suppose they have the same return, risk-adjusted return. And compounding for NP return is 1 plus R with n's power. And if you look at the tax deferred account, is that account with n power, say the retired people putting the money into the next 10 years, and then eventually after 10 years you have to pay tax, but it's based on income tax. So this is this calculation. And the taxable income is that every return, every year you get a return, you have to pay tax. So 1 plus R times 1 minus tax rate with n power. This will give you the lowest value. And the second highest value is this, is 1 plus R with n power minus the capital gain tax based on the total amount. However, because deferred tax, previously we already discussed, there's a tax benefit come back here. So the capital gain tax benefit, all right, give you the outcome become much higher than the taxable account. So it's a 1 plus R return with n's power minus 1 minus the capital gain tax rate plus the tax rate, which is the tax benefit. So usually we were facing some question is what type account suitable to whom? Like textbook account, of course, is for trader because they trade frequently. For the passive investor, here we're saying the cost base is equivalent to the investment base with this formulation. But anyhow, the deferred capital gain account is very suitable for like ordinary investor with a passive. They just for their long-term saving and growth. Um, Active investor, you can use the tax defer to defer their income because they are very active. They have a high income. On the other one, the exempt investor, some of the special purpose or high net worth for estate purpose, to estate tax purpose, they can use this account called tax exempt account. Okay, so here summarized. Who actually it's better to put in the tax exempt account if it is expected to have a significant increase in the future income. So the tax rate will increase for those persons who immediately will have a higher income source in the near future. So you better just set up some kind of tax exempt account. Otherwise, you're going to pay a huge amount of tax. All right. For example, some wealthy investor they convert their private firm to the public firm, and they're going to huge it down again. So they usually have to really set up some kind of tax exempt account to reduce their tax exposure. Um, Now, if you are going to retire, and because your tax rate, the total tax rate has become lower, and it's better to go into the tax defer account because it's going to defer because you retire. All the return from your retirement account become income source. So they're going to defer your income tax. So using the income tax defer account to save your tax.